Okay, we're now going to switch over to government budget, which begins Unit 2, where we really start to get down and dirty into some central concepts in macroeconomics. To build out some of our vocabulary, I like to start with the government budget. It will introduce certain ideas and kind of get us prepared for when we do GDP and all the other things coming up. So, and it's nice too because there's actually a conversation about the budget going on in the news. Bring in the current events. I'm going to bounce back to this. I have lots of data to show you, so I like to keep this up for this time around. Let's start with taxes. So I just time. All right, we'll be okay. There are 3 types of taxes that we can use, that we can think about. It goes into 3 different categories. Progressive, flat, and regressive. Has anyone ever heard of these terms before? Progressive tax, regressive tax. Anthony, what are they? What do they mean?
Progressive taxes.
Close. Close. Progressive tax means as income goes up, the tax rate goes up. So we want to be very clear, right? Because when you just say, oh, we have more taxes, it's like, well, that's not, we're not saying that the dollar value increases. We're not just saying that. We're also saying that the percent of your income that goes to taxes increase. You can probably guess what regressive is. What is regressive? Anyone?
As income goes up, the rate goes down.
The rate goes down. And then flat. Anyone want to guess?
The tax rate is the same.
It's nice to familiarize ourselves with these terms. Generally, economists like progressive taxes because of diminishing marginal utility. As you make more money, then each additional values become less and less valuable to you. So it kind of makes sense for the government to take a larger and larger hunk. We are not fans of regressive taxes, generally speaking, because you're sort of like punishing people who are really struggling disproportionately. That just seems mean. So we will talk in terms of, well, that tax is regressive, that tax is progressive. All right. So here, for example, this is the 2021-2022 tax schedule. A little old, but it still does the job. And we're going to have to highlight something not obvious about the way taxes work. Let's imagine, I'm going to take a simple extreme example. That's not right. Let me see if I can find a marker that doesn't suck. Marker suck? Yes. So, let's say somebody is making in taxable income $9,950. How much money do they pay in taxes? Yeah.
0.
So in taxable income.
You do the standard deduction.
That's why I said if it's taxable income, that's after the standard deduction. So how much do they pay in taxes, according to this? Take 10% of it, and I assume you did that in your head, right? Yeah, good. Okay, now let's imagine somebody gets a $1 raise. How much do they pay in taxes?
$195 and 12%.
Exactly. Everyone hear him? So I want to emphasize something to you. Do not think in terms of I look at where we land and then I take that number. If you land in 9951, you are not paying 12% of your whole income. These are marginal tax rates, which means you put your money in these different buckets of different sizes, and then different amounts of money are taxed at different rates. To illustrate why that is, let's imagine the way not to do it. What is 12% of 9951? Or actually, just do this. That would be faster, and I can show you the data. I love Excel. Let's we have to wait. Okay. So we have not. Sorry, I don't like it when the numlock key doesn't work. Fine. 9950, and then we have 995. So if we did this times 0.1, as mentioned, 995. Our after-tax income would be the difference between the two. If we do the same thing, if we take the whole 12%, it's about almost $1,200. Note our after-tax income. This is weird by any standard of the word, right? I was, after taxes, getting paid $8,955, and now that I got a raise, I am making less money. This is why the tax system does not work this way. If it was just a simple matter of where's my income, where's the bracket, and my whole income is taxed at that amount, then you would get these weird incentive issues of people getting raises, going into a higher tax bracket, and then suddenly having less money as a result of the raise. And so the tax system does not work like that. It separates things into buckets. Let's do a simpler one to illustrate. Let's imagine I had one that went from like, I don't know, $0 to $50,000 a year, and then $50,000, $1 or more. And the first was taxed at 10%, and the second is taxed at 20%. Let's imagine somebody makes, I don't know, we'll say $70,000. How much did they get taxed? Based on the actual, yeah, based on how it actually works. How much money fits into this first bucket? Yeah. 50. Exactly. And technically, I should put that in as $1. There we go. So the first 50,000 are taxed at 10%, and then the next, everything else is taxed at 20%. $20,000 at 20%, and so you would do 50,000 times 10, or 10%, plus 20,000 times 20%, and then you add them up. And this person owes 9,000 in taxes. It's best to think in terms of buckets. And so on. And that each bucket has a different tax rate attached to it, and it holds a different amount of money. And so as you take your income, what you do is you I mean, you don't do this, the IRS does this for you. But you put the money in the different buckets, filling one up, filling the next one up, filling the next one up, at higher and higher marginal tax rates. Remember, what does margin mean? Change in total, right? So that additional dollar, as Liam points out, only that additional dollar, that marginal dollar, is taxed at 12%. You will always end up getting a raise and keeping it. So these are our different tax brackets. And you can see it here. How much do you owe? 10% of income. And then this one is 995 plus 12% of the amount over 9950. Or 995 and 12 cents. And guess what this 446 is from? How do you get 4664?
95 plus 2%.
Okay, you have to do this difference right. As I'm doing this, I'm realizing more. So it would be 40525 minus 9950. And you might wonder why I'm putting 9950, not 9951. You want to take a guess as to why? Look, I can always, I know I have a hard time describing this too. I always use an example. Because you want to think in terms of the individual dollars. So if we do 6 to 8, taxing the 6 at a certain percent, the 7 at a certain percent, the 8 at a certain percent. How many numbers is 6 to 8? How many numbers is that? How many numbers, if we go from 6 to 8, how many numbers did we just include? 3, right? 6, 7, 8. But if you take 8 minus 6, you get 2. Because you have to include you're not including the endpoint. So that's why I removed one of them. If you get 8 minus 5, you get the 3 that you need. 6. So I did 9950. If you take that 9950, multiply by 4.2, add in the this plus the 995 from before, you get 4660. Right there. That represents the stuff that we've accumulated so far. So let's imagine you make like $80,000 a year. The taxes you owe are going to be 4664 from the previous two brackets, plus 22% of anything over 4525. Right? Yep. It's just making the math easier. So but these are where the numbers come from. What this means is we always think on the margin. So if somebody's making $1 million a year, and they make a charitable donation of, say, $100,000, that charitable donation does not actually cost them $100,000. Why not? It's tax deductible. Which means if you give $100,000, your income is functionally $100,000 less. You do not pay taxes on it. So that $100,000 of income, that $100,000 charity donation saves you $37,000 in taxes. And so it actually only costs you $61,000. Or $63,000. No. So, sorry. Let me do it this way. Let's imagine scenario 1. Person's making $1 million a year. And they're going to get hit by this huge tax amount. I don't want to do the math to figure it out, but let's just say it's like, I don't know, roughly maybe $250,000. And someone's like, hey, if you donate $100,000 to charity, you can reduce your taxable income. That's what tax deductible means. So the government doesn't think that the government doesn't treat you as making $100 million. The government treats you as making $900,000, which means you only pay taxes on $900,000, which means you don't owe $250,000 in taxes. You owe, when you do the math, I'm estimating, but when you do the math, you are making, let's see, 37 minus that is 213. So in reality, that $100,000 donation didn't actually cost $100,000. It costed 60. I'm sorry, 60. Yes. Does that make sense?
Yeah, that makes sense. But 37,000 is what's you.
It's what you do not have to pay in taxes because your income is functionally for tax purposes. Right. By removing $100,000 in taxes for taxable income, you are removing $37,000 in taxes because the marginal rate is so high. Yeah.
But you still gave 100,000.
Yeah, you still gave it. But like, why do people ever give money away? Like, what? To be nice? Maybe because they believe in some sort of project that the person's doing, right? Maybe it's to get their name on some sort of building and then have people throw them at an event. Like all kinds of reasons why people give money away. And so all of a sudden, these things that you want to do become cheaper. And thus, we would expect more of it. So one of the things, we'll talk about this later, but one of the things, when you increase the tax rate, you increase the incentive to give money away to donations. And thus, the government doesn't collect as much money in taxes. Right? There's a trade-off. Well, yeah, they gave away 100,000. They save 37,000. So they get credit for 100,000. Like imagine, for example, that we're saying, hey, if you want to get a name on a building, you got to give us $100,000. And it's like, okay, it cost me 100,000 to get my name on a building, but actually, it costs me 63,000 because I'm paying you 100,000, but I'm taking 37,000 from the government, or not giving them 37,000. Does that make more sense? You're still paying. I'm still giving them money to them. There's the charity is pocketing, a six-figure donation, but my tax guy is saying you don't have to spend those 37,000. You're saving 37,000 in taxes. Yeah. You might get a nice big rebate actually from the government. In fact, when you do your taxes, if you have your taxes done by a professional, they are asking you constantly things that they could find that will reduce your taxable income and thus give you a bigger refund. That's that process. The government will give you that money back. Flat tax, so I think it's pretty straightforward. Regressive tax, so people have a hard time sort of wrapping their minds around. When the hell does the government have a regressive tax? You can see that this is a progressive tax right there on what's printed. But regressive tax is weird. Remember, what defines it is based on income. And sometimes what people are actually, and so what people are taxing though is not income. Simple example. What's the fine for parking in a handicap spot? $250. Okay. You know what a rich person might say? Rich person's, yeah, what? Go ahead. That's nothing. Yeah. Right? The amount is fixed. Rich person might say, oh, we can park there. It just costs $250 to park there. You can park there. Like, in other words, while a fine is not a tax, a fine is regressive. These fixed values for fines, say it's $40 or it's $250 or $500. That means that as the income goes down, the percent that fine is goes up. Finland famously gives you a bigger fine if you make more money. And so there was I linked to an article. I think the guy got like a it was a crazy speeding ticket. It was a $103,000 speeding ticket because they caught some guy speeding and he was like uh what is it? In 2002, a Nokia executive was fined the equivalent of over $100,000 for going 45 in a 30 zone. So that's an example of them trying to make this flatter, right? Trying to make it not regressive. Because if you don't adjust for income, you get this weird issue where you're disproportionately punishing low income people because of the fines.
Wouldn't that be like the sales rate?
Because a flat is the rate doesn't change. That means the percent of the income doesn't change. That's what.
So like instead of the margin,
So here the average tax rate goes up as you make more money. That's progressive. Here it's like imagine a flat tax. There you go. A flat tax would be everyone just pays 10% of their income. Right. That would be a flat tax. Or 20%, whatever the number is. Here regressive is as you make more money, the percent of the tax goes down. Sales tax are also regressive. This is harder to see. The percent of the tax goes down. So or a fine, and that's why I said fines aren't really taxes, but it illustrates it really nicely because the fine value is always fixed, but the income, of course, varies based on the person. So the numerator is the same, the denominator is changing, and then the percent is going to change. Sales tax is hard to tell. Like, how is this regressive? What is a sales tax? What's the sales tax in, say, in Maryland? 6%. I don't know why I made that zero so large. 6%. What's it taxed on, though? As indicated, sales. So, if you're low income, what percent of your money do you spend on like stuff that would be subject to a sales tax? Like groceries, and I mean, we're going to avoid the weedy issue of some items are exempt from sales tax and some are not. But generally speaking, poor people spend most of their money. They save very little, right? Poor people spend most of the money. So let's do a simple version of this. Let's imagine somebody makes, we'll say, $30,000 a year. Actually, no, let's make it 20 because that makes the math a little easier. $20,000 a year. They spend $20,000 a year. How much do they pay in taxes? In sales tax? You can do the math in your head. 2 decimal points over, then multiply by 6. Unless I did the math wrong. Because 6 times 20,000 is 120,000, and then it's 0.06, so you move the decimal point over to 1,200. Yep. And so the rate is 6%. But let's imagine there's somebody that spends $200,000. I'm sorry, they make $200,000, and they spend only $100,000. How much do they pay in taxes, in sales taxes? 6,000. What's 6,000 of 200,000? Even though the rate is fixed, it's always 6%. It seems like a flat tax. In practice, because richer people save more income and spend less as a proportion, that means a smaller proportion of their income is subject to this tax, which means in practice, they're paying less in sales taxes proportionally. Sales taxes are regressive. need to be, which is why there's all these exemptions. It's like, okay, well, we're not going to like tax. Bread is not subject to sales tax, right? Onions aren't subject to sales tax. There's all these crazy fighting rules that happen around it. So we haven't actually talked about the government budget yet. The government budget. This is kind of where they get their money. And broadly speaking, they're going to get their money in three different places. The what's called that revenue. There it is. Income taxes. So this is exactly what we talked about before. The vast majority of income taxes. I'm sorry, there's a huge chunk of income taxes. This is the biggest source of revenue. It being about tax time, probably what you're thinking of. There are also something called payroll taxes. Does anyone know what payroll taxes are? So this is a tax. So what's the payroll tax? Yeah. Mm-hmm. Yeah. So it's Social Security, Medicare, and it is it's you see it as mentioned. You see this on your W-2. Here's the fun thing about tax. I don't want to say it's fun. Some of it is paid directly by you. You see that line taken out. That money is taken out of your paycheck. It goes to Social Security. There's also a section that is paid directly by your employer. Here's the fun fact. Not really a fun fact. Much of this is paid indirectly by you. Now, I know that's weird. I just said it's paid directly by the employer. How can I say it's actually paid by you? Let me give you an example. Let's imagine I hire you, Emily. And I'm like, great, I've hired Emily. You're making $50,000 a year. Nice job. And then I'm like, oh, shit, when we were talking about how much I'm going to pay her before I hire you, I'm talking to my accountants, and it's like, well, you didn't consider the fact that we have to pay for part of your Social Security. We have these payroll taxes we have to pay. That's an expense to hiring people. And I'm like, oh, well, we can't afford to pay her $50,000 a year and to pay taxes to the government on that. So what do? What? We decrease the salary, right? Yeah, we pay $50,000 and we reduce how much we pay Emily, so we can give that money to the government. In other words, you are paying that indirectly because you took a lower salary. Salaries are lower than those would be because of the payroll tax. Finally, corporate income tax. There are changing rules all the time. There's like changing tax codes and all the time. But as of now, this is a flat tax. There's stuff in the Biden administration where they put in like a minimum corporate tax. I don't know if that's going to stick around. Who knows? But it's currently 21%. At least according to my notes. Maybe that's changed since then. It's currently about 21%. And this is a tax on corporate profits. So these are the three big sources of revenue for the U.S. government. Would have any questions? Let's look at the data then. First, let's dispel a couple of myths. Some people have said that the U.S., while on paper it has a progressive tax system, the rich have so many tax benefits and so many ways to avoid taxes, they don't actually end up paying a higher portion. That is not the case. So here is the average tax rate based on income group. I don't know how well you can read it, but I will zoom in. Maybe you can read it a little easier. This is from the Tax Foundation. So 2022, the latest data we have at the time, this was made, top 1% pays roughly a quarter of all their income. So you note that it doesn't match up with that top rate of 37% because this is essentially, okay, let's just take a look at all the money that you pay the government in income taxes and look at how much money you have in adjusted and taxable income. And we'll just do this, to do the math, what portion actually went. And so it's going to effectively be an average of all that stuff. It's about 25%. That's, by the way, why I picked $250,000 rate. And then it goes down as you get to lower brackets. So it is true that as you make more money, a larger share of your income goes to taxes. Who pays most of the income tax in the United States? Who contributes the most money? The rich. How much? Like what percent of all the income tax that the government collects do you think comes from the top 20%? 25%? Keep in mind, this is the percent of their income that went to taxes. I'm talking about the government collects taxes from everybody, has this big block of income tax. What percent of this income tax came from the 1%?
30,
20,
35.
35. Latest data we have, it's 40%. 40%, even though the richest 1% made about 22% of all the adjustable gross income, which is a lot. They paid 40% of all the income tax the government got. And then if you look at the pretty darn rich, which is 5 to 1%, that's 60. So right here, we're looking at that's 20. So this is like 60% of all the money came from the top 5%. About 70% came from the top 90%. I'm sorry, from the top 10%. So the vast majority, and then here's the bottom 50%. Right? The poorest half of the country pays 3% of all the taxes. So the vast majority of the money comes from the very rich. So when people say the rich don't pay their fair share, I don't know what that means. I'm not saying that's wrong. I'm just saying I don't know what that means. Does that mean they don't pay their fair share of the total pool? And that this should be like, 50 or 60, but again, people tend to think it's lower than that? Or do they mean that they should pay more than 25% of their income? And that's what they mean. Yeah.
I think they have in mind maybe a real person for just rich person who has that really expensive.
Yeah, and they certainly exist. Right, they certainly exist. But then it's like, anecdotes are not data. Right? So we always have to be careful about that. So let's actually show you the data. It's always nice to see the data. I'm going to do things slightly in a different order because I've been thinking maybe I should do it here. And I'm going to just do it here. It'll be fun. Yeah, let's do it here. So, with respect to what you said, It is not obvious what to do about taxes if you want to increase revenue. Imagine we have the tax rate, the percent of income that the government takes in taxes, which will range from 0 to 100%. And here we have the government's tax rate. Clearly, if the government says we're not collecting any money in tax revenue, the total tax revenue will be 0. If they collect 0% of income, their revenues will be nothing. Now, notably, that same is true if they say we're going to collect all the income. If we take all of the money that everybody earns and put it in our own pocket, we're not going to collect any money. The revenue is also. That seems weird. Why does that seem weird? Yeah. Exactly, right? Think of all the things that we can do to adjust. We could say, oh, you're going to collect all my money? I'm not going to work, as Avery points out. That's one way. Oh, you're going to collect all my money? Well, all the money that I collect, I'm going to give to charity. Right? If a $100,000 donation only cost me like $63,000 because I saved money, imagine if a $100,000 donation actually cost me nothing. I'm just going to give it away. Why wouldn't I? Or maybe I will work, but I won't tell the government about it, and everything goes into the extra legal sector, into the black market sector. Right? If you tax at 100%, you're going to have such a strong incentive to avoid and evade taxes. Does anyone know the difference between tax evasion and tax avoidance? Yeah.
Tax avoidance, not reporting something, tax evasion is actively lying.
No, not quite. Tax avoidance is legal ways to not pay taxes. If you're not reporting something, that sounds illegal. Tax evasion is illegal ways to not pay taxes. So tax avoidance is, ooh, I see I'm going to get hit by a really big tax bill. If I give money away, I can reduce my tax bill. That's totally legal. Or Amazon would famously store money offshore. A lot of companies do this. They store money in different countries, and then they're not subject to. That's perfectly legal, and they're avoiding taxes. Or they will do a lot of R&D. That's tax deductible. That's avoiding taxes. Or people might, if you sit down with a professional to do your taxes, and they will go through all the lists of things that they can include in tax deductions, that's them doing tax avoidance. It's totally legal. They're just trying to reduce your tax bill. That's what they pay to do. Tax evasion is illegal stuff. I'm going to operate in the black market, right? Or I'm not going to tell people about it, or I'm going to start, selling meth or whatever it is. The idea is the higher the tax rate, the larger incentives to avoid and evade taxes. And so the actual revenue curve looks something like this. This is what we call the Laffer Curve. When you hear about people saying, if we cut taxes, we will raise revenue, this is what they're talking about. They're saying, our taxes are too high, and thus there's a huge incentive to avoid and evade taxes. If we just cut the taxes, then people will say, well, I'm not willing to go through that effort. I'm not willing to maybe donate to charity or, concoct some sort of ridiculous stories. Or for example, when a person cleans out their house and they say, you know what, it's time that we donate some of this stuff to charity, I'm tired of looking at it. Well, if the tax rate is high enough, they will suddenly also include that in the tax revenue, include that in their taxes. They were going to get rid of that stuff anyway. But now they have an incentive to tell the government about it. And so the idea is, well, we reduce the incentive to do that stuff. Lower the tax rate, increase revenue. Does that actually happen in practice? It's hard to tell, but that is the argument. The Laffer curve illustrates that there is a sort of concave relationship between tax rate and tax revenue. It's not a simple, if you just tax more, you get more. It doesn't work that way. We don't know the exact shape. The peak could be over here at a really low tax level. It could be over here at a really high tax level. I just drew a generic concave shape. But it does illustrate the tension. It's just saying, oh, the answer is to raise taxes. It's like, well, now you're increasing the incentives to avoid and evade taxes, and it's not clear you're going to get more money. There's some European countries that instituted a wealth tax, and as a result, wealthy people fled the country. And I don't want my business to be tax non-existent. I don't want to have to sell off parts of my business to satisfy this. And so then their tax revenue fell as a result. They didn't collect nearly as much as they thought they would. Okay. Any questions? All right. So, what do you think is the biggest source of revenue for the government? We had the three things. I mean, there's more than these three sources, but these are the three ones. The three big ones: income, payroll, and corporate. Which is the biggest source of revenue? Income tax. We have the data right here. By how much? Yes. In 2023, total revenues were $4.4 trillion. Half of it came from individual income taxes. Half of it came from you guys. Well, again, half actually came from really rich people. Payroll taxes, though, also a big hunk. Corporate income tax is right here, really small. I don't know how you can read that, 420 billion. And then there's other sources of revenue that they have. There's fines and fees and all this stuff. There's like tariffs, they get money from tariffs. Okay, well, if they have 4.4 trillion in revenue, how much do you think the government spends?
Around 6.
It's around 6, yeah. I think it is, where are my numbers? I think it's 6.1 trillion. So, we're going to talk about the three categories of stuff this involves. One, there is a category called mandatory spending. Sometimes the government creates a law such that if people meet the eligibility requirements, they get money. They get support. They are entitled to that support if they meet the eligibility requirements. These are called entitlements. They are part of mandatory spending. The government must pay based on pre-existing laws. There's no max spending here. Because it's mandatory, because they're entitlements, if there are more people that qualify, the government has to spend more money. They can't say, oh, we ran out of money, guess you don't get your benefits. No, by law, they are entitled to them. An entitlement is a benefit that you have guaranteed access to if you meet the requirements. Many entitlements are what we call transfers. I'll write transfers up here. I'll write it up here and I'll write it down here. Down here for the video, up here for the for you guys. You guys are more important. Transfers. Sometimes the government spends money, but doesn't get anything in return. Sometimes the government sends people checks, and it doesn't get anything back. It's not buying anything. It's just transferring the money. So spending without getting anything. Donations are transfers. You transfer as well whenever you donate to someone somewhere. That's a transfer. So, mandatory spending is one big hunk of the government spending. Another big hunk I guess I'm going to put it over here. This one's simpler. Discretionary spending. What is discretionary spending? Yeah, Liam.
Money that Congress has control over its distribution.
Could you give me an example?
Additional funds for filling in budget shortages for certain agencies.
Not just budget shortage, just the budget in general.
Or the budget in general, or if they, need extra money for some reason, or if there's a certain program that the executive wants to try and get funding.
Exactly. Discretionary spending is spending lawmakers control with explicit numbers involved. When we talk about discretionary, note there's no max spending. You spend it just based on the requirements. You spend based on how many people fulfill the requirements. With discretionary, there's budgets. There's a certain amount of money set aside for NIH. There's a certain amount of money set aside for the Pentagon. There's a certain amount of money set aside for the Bureau of Printing and Engraving. Right? There's a certain amount of money set aside for these different agencies. So this is going to include defense, and non-defense spending. Now, the last item on the list comes from this asymmetry. We got 4.4 trillion in revenue. We're spending 6.1 trillion. That's more. So what's going on? How are we spending more than we take in revenue?
Debt.
Debt, specifically, technically, give me a little bit. That's right, and not exactly the answer I'm looking for, but it's pretty dang close. Specifically, what do we do? What does the government do?
Paying back debts.
So it is a deficit that contributes to the debt because the way that we make up the difference is we borrow money. And when you borrow money, what do you have to pay?
Interest.
Interest. So every dime and dollar that the government borrows, they have to pay back plus interest. And as we are borrowing more money, we grow the debt. We have to pay back We have to pay interest on the debt. Any questions? Yeah.
Does that mean the interest is factored into the spending before it's spent?
What do you mean? Like we borrow the money, and then we get this block of money to pay off all these various things,
Yeah.
and then that adds to our liabilities on the balance sheet. Is that what you're referring to?
Yeah.
Yeah. So then that's going to be, and so that's why interest is a part of the budget. Of these three items, mandatory, discretionary, and interest, which is, you have a question? So it's kind of weird. In some ways, the debt is constantly being paid off because the government is constantly issuing new securities. And if you have that security, we, with one weird instance, I think in the 70s, we've not only never not paid back the securities in the entire history of the country, we've never been late. So there was one weird instance where there was a printing error or something in like the 70s, and we were late with a payment. I say we, I'm not part of the government. The government was late with a payment. So on the individual security side, yeah, we pay it off. We always pay it off. But will the debt ever be reduced to zero? Yes, because it can't go on forever. Let me be careful what I say. Will the debt keep growing indefinitely? I don't think so, but it's going to take a disaster to stop that. It's going to take some sort of big event to really be serious about it. Because what do you think the biggest item is on the spending? Mandatory, discretionary, or interest? What's the biggest one? Nope. Not even close. Mandatory. Here's our federal budget broken down to those three categories. Here's the net interest. It's called net because the government gets interest because it makes some loans. But here's the net interest on the debt, about almost $660 billion for this year, for last year, for 2 years ago, 2023. We don't have the 2024 numbers out yet. Discretionary, a bit bigger, roughly half defense, half non-defense, roughly. And then the vast majority of it is mandatory spending. The vast majority. If you take all of Social Security, for example, it's not only covers all non-defense, it covers like half of defense. And that's just Social Security. Another big hunk Medicare, another big hunk Medicaid, another big hunk income security programs. And then there's a huge other category as well. The other category includes things like veterans benefits. And then we have like earned income tax credit, supplemental programs, like this is school lunches and so forth, or what's it called? Food stamps, used to be called food stamps, unemployment compensation, child nutrition programs. The current conversations going on about let's balance the budget by dealing with federal workers is this. That's the whole thing. So if you were to cut and fire every single civilian federal worker, ranging all the way from like people who work at NIH to people who work at USAID to people who do the air traffic controllers to the park rangers, if you cut every single one of them down to zero, you would not close the gap. If you want to close the gap by cutting spending, you have to deal with entitlements. It's by far the biggest item on the roster. Yeah, go ahead.
So what would the motivation be for employees? Would it be like, is that like a lack of education on the actual state of the budget, or is that like?
Well, they know. There's no way they don't know.
Yeah.
There's a lot of theories. I don't want to jump into people's heads and try to figure it out, but like one thing is it just sounds nice. Like both parties tell themselves this fantasy when it comes to balancing the budget. Republicans say we can balance the budget by cutting out waste, fraud, and abuse, right? And we can just fix everything by cutting out waste, fraud, and abuse. And that's not true. There's not like $1.7 trillion of waste, fraud, and abuse. It just doesn't make sense. Unless there's like tons of fraud in Social Security and Medicare. And there is fraud in Medicare and Medicaid. It's probably a lot of fraud. It's probably not enough to cook. Democrats like to tell a story that we can close the gap by just taxing rich people more. And that's not true either. If you take the richest, like 1%, and you said, okay, we're going to raise taxes on them, you would have to close this gap. You would have to raise taxes. It's currently about, as you saw, about average 25% they pay. You would have to bring that up to 75%, which is so high, Laffer Curve kicks in, and they avoid those taxes. And by the way, that is before you deal with any of the other taxes that they have to deal with. You know, because that doesn't include state and local taxes. That doesn't include payroll taxes. That doesn't include like estate taxes. That doesn't include sales taxes. It's just not viable. Like, if you want to balance the budget, it's a combination of cutting these benefits, not just waste, fraud, and abuse, but cutting these benefits and raising taxes on the middle class. So, neither of which are politically popular. Hence, oops, that's not what I want. The U.S. government consistently runs a deficit. With some, right, so this is the federal surplus or deficit. So here's the zero line of a balanced budget as a percent of gross domestic product. I'll cover it today. So the last time the U.S. government had a surplus was before I think any of you were born, which is around like 2000, over 20 years ago, 25 years ago. And the reason why we're always running a deficit is because voters like spending, voters hate taxes. That's it. Any questions? That's really quiet. That's not an unusual response. Yeah, go ahead.
Wait, so why did it go up?
Oh, like what? So whenever you see one of these things increasing, it's usually not because like the government has cut a lot of spending. It's usually because there's some sort of economic expansion, and as a result, they get more money in like tax receipts. They get more revenue. Yeah. Plus, you know, like because of the way it's as a percent of it, so you know, if the spending is if GDP goes up, then that means like this percent goes down, it becomes less bad, and then they happen to get more tax revenue. So then someone says, "Oh, so case in point, 2000 election, there was a surplus." Does anyone know who was running in 2000?
George Bush and Al Gore.
Exactly, and they made each campaign promises of what to do with the surplus. So Bush said, "It's the people's money. I'm going to give them tax cuts and give it back to the people." And Gore said, "Let's pay down the giant debt that we have from all the other years that we ran a deficit." Who won that election? Bush. And narrowly too, right? Had Gore come up with some sort of like, let's put money in, build some infrastructure in like, in Florida, that might have tipped the scales and would have won. But the idea of being responsible and paying back the deficit doesn't really like excite people.
Wait, so just like a lot of people made money that year?
Yeah, a lot of people made money that year. Remember, this was the dot-com burst. So this is the dot-com expansion. This is when the internet started being a thing. And so there was a huge expansion. And ultimately it was temporary. Like this thing is not like a rule. This thing was kind of a bubble that burst because people were like, there was a lot of money flowing around about, oh, I'm going to like sell pet food online and then make a really janky, terrible website, and people say, "Oh my goodness, you're going to become a billionaire," right? And then a lot of money was flown in, people were happily paying the taxes, they didn't really care, and then the dot-com bubble burst, and that's this recession right here. This is the dot-com burst, and then of course there was 9/11, and so then military spending, and then here's the Great Recession, so more government spending. So it's possible that there is some crazy economic expansion. This is recovery. But if there's some crazy economic expansion, it's possible that we could dip over here. But it's probably not going to be sustainable because even when we dip up there, there's such a strong incentive to give the money back to the people, spend the extra money, right? Not be responsible, and we dip right back down. Okay. Are you depressed yet? No? Okay. This debt is total percent of GDP. I'll check for that. Then let's show you how much debt then do we have in total? All those years we've accumulated debt. How much debt do we have in total? Here's the U.S. national debt clock. Currently running at, count the commas, $36.5 trillion. And the clock is ticking. Ask me, like, can we run a debt forever? Oh, can you run a moderate debt forever? Yeah, probably. Can you run an explosively large debt forever? No. At some point, we are going to have some serious trouble. But it's going to take a financial disaster to change the incentives. In fact, I could even highlight this for you because it might come sooner than we think. Yeah, I want to show you this really quickly. Take a look at the. So here we go. This is better resolution. We had about 660, right, for billion for interest. Last year, I'm sorry, the last time we looked at 2022, the year before, the interest was 475. So it's almost a $200 billion increase. It's more than a 33% increase in 1 year. That's largely due to the increases in interest rates we've had, and all the debt that was accumulated during COVID. And so this problem is accelerated. Yeah.
What happens if people stop buying?
So, well, one thing to keep in mind is during COVID, the public largely didn't buy the T-notes. The Federal Reserve bought T-notes, which is, and we'll talk about this when we cover inflation, led to a huge increase in the money supply, led to inflation. So if we have some sort of disaster, like maybe a big economic downturn like we saw in 2009, it's not clear to me. Maybe people will still buy U.S. foreign debt because it's such a safe asset, at least historically. So the Federal Reserve will have to buy some of that, and we might get more inflation. And at some point, things will just become a huge mess, right? People aren't willing to lend us money, and there's no toleration. And the Federal Reserve doesn't want to buy any more of this debt because they're really concerned about inflation. And I don't know. It's a big question mark. Yeah. So I used to say before COVID, I was like, this probably isn't your problem. It's probably your kid's problem. It might be your problem. Accelerating.